Investing in the stock exchange can be a volatile experience, with you not knowing from one day to the next what the value of your investments would be. One day, the value of your shares can make you feel like you're riding on the crest of a wave, and then the next, it seems like the whole world has collapsed around you. And the stress created by this value uncertainty can make many would-be investors give it a miss, or to cash out their existing investments and never to return. In this video, we're going to look at what you should consider as an amateur investor if share prices plummet or the stock market crashes, causing the value of your portfolio to drop significantly. Should we sell, or should we keep calm and carry on regardless? Before we get started, I need to tell you that this is a financial education video and should not be construed to be financial advice. Always fact check anything that anyone tells you on YouTube, including what I tell you during this video today, and seek advice from a suitably qualified professional if unsure of anything. So why is the stock market so volatile? Well, a principal reason is supply and demand. This is a fundamental principle in the stock market that determines the price of stocks and shares. And the price of a stock at any time is as a result of the balance between supply and demand. Supply refers to the number of shares available for sale. When more shares are available than there are buyers, then the price of those shares tend to fall. And this could be because many investors decide to sell their shares at the same time, or due to there being little appetite for investors to buy shares. Maybe investors will sell shares simultaneously out of fear of panic of losing their money due to bad economic news or world events. Demand, on the other hand, is a desire for investors to buy shares. When more people want to buy shares than there are shares available, then the price of those shares will tend to rise. And investors might be encouraged to buy shares as a result of things like positive economic data, strong corporate earnings, or favourable interest rates. But there is a psychological reason also why people might decide they want to purchase shares, which is explained by an economic theory known as the scarcity principle. When there is a limited supply of a good coupled with a high demand for it, prices tend to rise. The more shares bought up, the less there are available, making them harder to purchase, thus tending to drive demand further, with prices tending to rise further and investors having FOMO, or fear of missing out. In such cases, this psychology could cause falsely inflated prices that lead to market bubbles forming as investors seek what everyone else is buying. Investors use diversification to try and reduce price volatility in their portfolios that is caused through market movements. Diversity, or diversification, is a market strategy designed to manage risk by spreading investments across various asset classes, sectors, or geographic regions. Examples of this could be investing across different asset classes, such as stocks, bonds, property, and commodities to help balance risk. For example, if the stock market moves downwards, then hopefully bond prices will help keep your portfolio a bit more stable, as they might perform better and offset any losses. Investing in different sectors and technologies, such as healthcare, financials, and technology, help to protect your portfolio from sector-specific downturns. If a particular industry faces challenges, then others might still perform well. Owning stocks from different geographical regions reduces the risk associated with economic or political issues in individual countries. Using varied investment vehicles, such as individual stocks, mutual funds, ETFs, and other instruments helps provide additional layers of diversification. By diversifying, the aim is to reduce the impact of poor performance from any single investment on the overall portfolio to achieve better price stability, while still providing reasonable returns in the longer term, as that positive performance that you get in some investments will offset and outweigh the poor performance in others. Mutual funds and ETFs enable you to potentially invest in thousands of countries at the same time, across many sectors throughout the world. Although not the main subject of this video, it is suggested that amateur investors should do some research in relation to passive mutual funds and ETFs, as an easier, low maintenance, and low cost way to achieve diversity to help manage the risk in your portfolios. I've created many videos on ETFs and mutual funds if you want to check these out on my channel, and I'll leave links during this video and in the end cards. And if you do enjoy the content of this video, then please consider hitting the like button, subscribing to my channel, and turning on your notifications so that you'll be aware of when I post new content. Even if investing in a diversified fund or ETF, the market value of your investments could still fall sharply in a global meltdown. In these circumstances, there would undoubtedly be panic and fear, with many investors looking to sell out, creating a situation when supply outstrips demand, with share prices spiralling downwards further. But do you follow others and try to cut your losses in these situations? Well, if you do decide to do this, then you are probably making your decisions based on emotional responses, such as that panic or fear. Emotional knee-jerk reactions can lead to poor financial decisions being made. And when markets are falling, there's a bigger chance of you making those poor decisions. In times of uncertainty, when others are panicking, it's important that you recognise what's happening within yourself emotionally and take a step back to reflect before making any decisions. In fact, if you look at this chart, which shows you the most likely times when investors will cash out, you will understand what famous investor Warren Buffett means when he says that investors should be fearful when others are greedy and greedy when others are fearful. Because when the market is down and people are selling in panic, an opportunity presents itself to buy potential investments of quality at lower prices. When markets fall and the value of your portfolio plummets, you have three main choices. The first is that you can cash out like all the others and realise those losses. The second is that you can try and ride the storm and hopefully come out of the other side unscathed. And the third is that you can get proactive and decide that now is the right time to start buying investments. I think I know which side of the trade I would rather be on, and that is a side that's buying for cheap rather than selling for cheap. And if past performance is anything to go by, stock markets quickly recover and go on to reach new highs. So taking the opportunity to purchase these lower price investments during market downturns could help you achieve greater profit in the longer term. The recovery time of the stock market can vary depending on the nature of the downturn, but the best historic trading days have often come shortly after a crash. For instance, 2 days after Black Monday in 1987, the Dow Jones Industrial Average rallied by about 10%, with that very same index rallying by similar amounts after the 2008 financial crash. And this graph shows the 11 bear markets, that is a market when prices are falling, in the S&P 500 index between 1926 and 2019, to show how short-lived these market periods are before going on to longer and productive bull runs that average about 6.5 years. Thinking about the purchase price, rather than cashing out, might encourage you to avoid following the crowd, which might help you in making more rational and potentially profitable financial decisions. I'm not advocating that you wait for cheaper prices and market falls before you start investing, by the way. This is your choice, of course, but if you do decide to do things this way, you could be making a mistake of a different kind. For one, every minute that you're not invested in the stock market is a minute that you're not maximising growth opportunities that the compounding effect will bring for your longer term financial objectives. To illustrate this, let's look at Jack, who at the age of 25 starts investing £20,000 per year, a full 10 years earlier than Jill, who at the age of 35 starts to invest the same amount. Even though Jack stops investing 10 years after starting, he still ends up with more money than Jill at age 65, where she invests for 30 years. From this, you will see that time is a precious commodity, and the more you have, the more you give your investments a chance to compound. Being out of the market and waiting for the best time to join, for instance when you perceive that you've reached a market low, will reduce your investing timeline and potentially impede your financial objectives in the longer term. And if you did decide to wait for the market low, how would you know that the market won't go even lower the day after? This high-risk strategy is known as timing the market, where you make buy or sell decisions on financial assets by attempting to predict future price movements. It is extremely difficult to be successful with this method, where even professional investors, with all those additional resources and expertise at their disposal, struggle to consistently predict market movements accurately and consistently. And this next chart shows what a real lottery predicting the market is, with the professional investors depicted here with the black dotted lines consistently failing to call the US Fed interest rate decision, which is depicted in red, correctly over long periods of time. And this low rate of accuracy translates into the chances of successfully predicting the price of stocks and shares. Timing the market is also high risk in that it can lead to missed opportunities, as you could find yourself out of the market at the wrong time, and where you are then too late to react to positive market movements. So what is a more sensible strategy for amateur investors to follow? Well, if we take Warren Buffett's advice, then the majority of investors who are looking for a straightforward and effective investment strategy should invest consistently in an index fund or ETF, regardless of market conditions. Warren Buffett often refers to investing in the S&P 500 index, which tracks the performance of the top 500 US companies. But there are many other ETFs or mutual funds that track other indices in other parts of the world also. Index funds, also known as mutual funds, or other similar funds such as ETFs, exchange-traded funds, if passive, are lower cost than managed funds, so you can invest more of your money rather than paying fees and get it working for you. With these passive funds, costs are kept low, as they are just designed to replicate the index that they track, rather than trying to beat it, which is what you would pay a manager to do. Such funds provide broad market exposure to many companies, which reduces the risk of picking individual stocks by providing diversity for your portfolio. Mutual funds and ETFs have also been known to provide good long-term performance for investors, with those that passively track the S&P 500 index providing average returns of over 10% going back a long period of time. This return is better than the majority of those expensive managed funds, where you pay additional, often very expensive fees to a fund manager to pick stocks on your behalf. Warren Buffett adds that investors should take a long-term perspective when investing in index funds or ETFs through a method known as dollar cost or pound cost averaging, and that by using this method you will potentially be in the top 10% of successful investors. Dollar cost averaging, or pound cost averaging here in the UK, is an investment strategy that involves making a purchase of an asset over a longer period of time, regardless of its current market price. Instead of putting a lump sum in all at once, a dollar cost average investor sets smaller recurring purchases on a weekly or monthly basis, for instance, and buys assets without caring whether they are expensive or cheap, with the objective of reducing price volatility whilst accumulating as many assets as possible. To illustrate this, let's take a look at the following example. A pound cost averaging investor decides to invest £1,800 over the course of 6 months by making monthly purchases of £300 of a passive exchange traded fund that tracks the S&P 500. Over the course of 6 months, our investor accumulated 17.9 units of the fund and never cared about the current market prices. Thanks to dollar cost averaging, our investor's assets total worth are £2,058.50 at month 6. So his initial investment of £1,800 yielded him a nice profit of 14.36% over his initial investment, a profit of £258.48. The highest price of our asset was £120, and even though in this example prices never rose above that all-time high, our investor still made money, and there lies the power of dollar cost averaging. But what would have happened if our investor had tried to time his entry into the markets? This graph shows how effective dollar cost averaging is by comparing an investor buying shares in the S&P 500 over many decades by dollar cost averaging with a person who has done so by buying a dip. It assumes that the person buying the dip has somehow managed to time the market perfectly for all of those years, which is extremely unlikely, but even in this utopian example, the person who just dollar cost averages with minimum work or fuss still comes out on top. Bear in mind that these are extremely simplified examples to try and give you an understanding of the concept of dollar cost averaging. In normal circumstances, people engage in this strategy over several years. What we can learn from these examples is that dollar cost averaging simplifies the process of investing and takes away the majority of the decision making, which reduces the risk for inexperienced investors that want to profit from the financial markets by diluting the risks over longer periods of time. But a really important factor here also is that this straightforward and disciplined approach to investing helps investors stay committed to their investment strategy regardless of market volatility. But does dollar cost averaging work with individual shares? Well, not necessarily. Dollar cost averaging works well when it comes to funds or ETFs which consist of many companies, such as an S&P 500 fund or ETF. The reason for this is that such instruments are not dependent on a single stock for them to suffer a major crash, and also that the general tendency of the stock market on the whole is to keep on rising. Just because tomorrow one of the biggest stocks in the S&P 500 crashes does not mean that the whole of the S&P 500 becomes worthless, as we still rely on the assumption that the other businesses within the index will continue to do their business and grow. But if you choose to use dollar cost averaging to purchase an individual stock, you dramatically increase your risks if you don't know what you're doing or how to choose assets well and for the right reasons. A good example of this is if you were trying to invest solely in the stocks of Blockbuster by dollar cost averaging. If you did, then you would be ruined, as the company failed to adapt to future market conditions, with maybe its biggest mistake in being not acquiring Netflix and then going on to be bankrupt in 2010. But the S&P 500 did not suffer the same fate and has continued to grow since that time, and as we mentioned earlier, it's accomplished returns of over 10% on average per year. So investing in individual stocks by dollar cost averaging is not impossible, but it would require far more analysis of the stock in question to stop you dumping your money into something that could become worthless. Whereas in comparison, investing in the S&P 500 or similar index fund or ETF is a much safer and diversified investment. The longer that you dollar cost average for, then the less chance there is of you not getting back the money that you put in. This graph illustrates how your odds are reasonable even if holding your investments for a shorter period of between 1 to 5 years, which should be heartening to those who have a shorter investing timeline. But those odds improve to a 96% chance of being successful if holding your assets for 10 years. However long you have, your journey to success won't be a straight line, and you will encounter lows as well as highs en route to achieving your financial goals. But if you want to meet those long-term objectives that you set, you have to be able to accept that at times you might fall into the red. So in this video, we asked what you should do as an amateur, beginner investor, if share prices plummet or financial markets crash, and covered supply and demand, what causes the markets to rise and fall, how investors use diversity to manage this volatility, how invested in passive global index fund or ETF provides diversity with reasonable returns at low cost and with low maintenance, but how even a diverse portfolio can still be the victim of a market crash, why you should take a longer term view where you remain unaffected by short term events, and how part of this long-term strategy is one advocated by Warren Buffett in dollar cost averaging. So if the market crashes and the value of your portfolio reduces significantly, take a step back. Resist the urge to make an emotional decision where you cash out your assets based on panic or fear because you think it would be good to follow what all the others are doing. See the opportunity that market volatility and low prices offers. Understand that stock markets recover, often very quickly, and if past performance is anything to go by, these markets will go on to reach new highs. And finally, make sure that you stay in the market long enough to benefit and to ensure that you get satisfaction when those moments arise. Here are those videos on funds and ETFs that I spoke about earlier in this video. Once again, thanks very much for watching.